Hi everyone, I'm Aura Ogorian with ACAP Advisors and Accountants, and in today's video, we're going to talk about the benefits of an S corporation, also known as S Corps. Now, throughout the video, I'm going to mention a lot of related terms such as pass-through entities or payroll taxes, but I'm only going to briefly cover those. And the reason is because I've got several other videos where I go into much greater detail on each of those related topics. That way we can stay super focused on just the benefits of the S corporation. And if you want to dig deeper into other categories, you can look at some of the other videos I did where I talk about pass-through entities, payroll taxes, how to start an S corp, all the other topics that are ancillary to what we're going to talk about today. So when you're starting a new business, one of the most critical decisions you will make is choosing your business structure. While there are options like sole proprietorships or LLCs, many entrepreneurs find that the S corporation offers the most unique blend of liability protection and powerful tax benefits. As a CPA and a certified financial planner, I have a ton of experience with S corporations. Not only do I help my clients create their business structure, but I also help them operate their business, do their taxes, set up and manage 401k plans and retirement plans for their businesses. In fact, many of my clients own multiple businesses. And how are these businesses structured? S corporations. S corporations are by far the most popular business structure for nearly all entrepreneurs. Now, an S corporation isn't actually a separate business entity. It's actually a special tax classification that a corporation or an LLC can elect to have with the IRS. See, you don't just form an S corporation, you have to ask the IRS for permission to treat your existing C corporation or LLC like an S corporation. Now, I know this sounds a bit confusing, but I have a separate other video where I go into detail on how to apply with the IRS to have your corporation or your LLC be treated as an S corporation. Also, you should know that not all businesses are eligible to be treated as an S corporation. In fact, S corporations first start up as a C corporation, and as I said, must apply with the IRS to be treated as an S corporation. So every time you start a new corporation, it's actually a C corporation first, and then you must apply with the IRS to be treated as an S corporation. To apply, you must file Form 2553 with the IRS to ask permission to be treated as an S corporation, but your entity itself must also meet strict guidelines. For example, you must be a domestic corporation or a domestic LLC to be eligible for an S corporation. Also, your corporation cannot have more than 100 shareholders. Now, there are some exceptions for family members, but you cannot exceed that 100 shareholder limit. Also, the owners of your S corporation must be eligible shareholders. And I'll describe what I mean by an eligible shareholder a little bit later on. And then lastly, the S corp can only have one class of stock, but you can have different voting rights. Now, to be an owner of an S corporation, you must also meet strict guidelines. You have to be an individual who is a U.S. citizen or a resident alien. Certain trusts, such as a qualified subchapter S trust or an electing small business trust. Some estates are eligible owners of S corporations, and certain tax-exempt organizations, such as 501c3s. The following are prohibited from owning shares of an S corporation. A partnership cannot be a shareholder of an S corporation. A C corporation cannot be an owner of an S corporation. You cannot have shares of an S corporation in an individual retirement account. So your IRA cannot be a shareholder in an S corporation. A non-resident alien, with some minor exceptions, can also not be a shareholder in an S corporation. An ineligible corporation cannot be a shareholder. An ineligible corporation are things like financial institutions, insurance companies, domestic international sales corporations. They too cannot be owners of an S corporation. Now, if you break any of these rules, the IRS can terminate your S corp status, and it will cause major problems for you and the remaining shareholders. Plus, you have to wait 5 years before you can re-elect for your S corp status, unless you can prove to the IRS that it was an inadvertent termination. All right, we're just about to get started, but before we do and get into the 9 major benefits of the S corporation, if you haven't done so already, please take a second to hit the like button and subscribe. This helps us grow our channel and continue to provide valuable content. And if there's a topic you want me to cover in a future video, or if you need clarification on something I said in today's video, leave me a comment below. Okay, number 1 is no double taxation. This is the absolute number 1 benefit of an S corp, that it's not subject to double taxation. This is a major benefit, and it's the primary draw for many people to choose the S corp as their primary entity structure. See, the S corp is known as a pass-through entity, which means it only files an informational tax return with the IRS, and it does not pay federal taxes itself. In contrast, a C corp, such as Apple, is subject to double taxation, and that's because when the corporation itself makes a profit, it pays tax on that profit. And then when it gives that portion of that profit back to you as a shareholder in the form of a dividend, then you pay tax on that dividend, hence the double taxation. Now, an S corporation is not subject to this double taxation, again, which is why it's an appealing entity structure. I should also point out that this is only on the federal level. Some states, such as California, impose tax on the S corporation on a state level. Number 2, lower payroll and self-employment taxes. The second major benefit of an S corp is the minimization of payroll taxes, also known as self-employment taxes. Now, if you operate as a sole proprietor or a traditional LLC, all of your business net income is subject to self-employment tax, and you have to pay the full 15.3% in self-employment tax, which covers Social Security and Medicare. But the S corp structure changes this dynamic. When you're an S corp owner, you are the employee of your company. That means that you pay yourself a reasonable salary for the work that you perform for the company, and only that salary is subject to payroll taxes. Any profits that's left after that is paid to you as a distribution, and the distribution is not subject to payroll taxes. That means the more money your S corp earns, the greater the benefit that you reap from lower payroll taxes. Now, of course, the million-dollar question is, what is considered a reasonable salary, and how much should you pay yourself if you own an S corp? I will link a separate video on how to calculate a reasonable salary for your S corp, but in the meantime, here's some things to consider. Training, experience, duties, and the hours worked. So for example, if you're the president of the company and you work 40 plus hours a week and you only pay yourself $50,000 a year, well, that's not considered a reasonable salary given the amount of experience you have, the duties you have, and the hours that you're working. Company revenues are another driver. Is your S corporation making millions of dollars a year and you're only paying yourself $50,000 a year in salary? Well, that's also going to be a red flag. You should also consider the industry that you're working in. For example, if you're a doctor and you own your own S corp and you're paying yourself $50,000 a year, well, the IRS is going to know that you can make much more than that if you're working someplace else, and it wouldn't be considered a reasonable salary, and that too would be a red flag. Okay, benefit number 3 is a liability protection. Another crucial benefit of the S corp structure is the limited liability it offers its owners. So like a traditional C corporation, an S corp is a completely legally separate entity from its owners. That means that your personal assets, such as your house, your car, personal bank account, are generally shielded from your business debts and your business legal liabilities. Now, if your business were to face a lawsuit or bankruptcy, creditors can usually only pursue the assets of your company and not your personal wealth. This protection is a major advantage over a sole proprietorship or a general partnership where there's no legal separation between the business and its owners. In those structures, you could be personally held liable for any business debts or any business liabilities. Now, it is super important for you to know that for you to maintain this liability protection, you must treat the S corp as if it was a completely separate entity by following all the corporate formalities. That includes keeping separate books, keeping your business and your personal bank accounts separate, holding regular meetings, maintaining detailed records. If you fail to do any of this stuff, it could lead the court to pierce your corporate veil, which means that it would expose your personal assets to business liabilities. Another thing to take into consideration is that if you're a licensed professional, such as a doctor, attorney, accountant, architect, or an engineer, your state may require you to form what's known as a professional service corporation. Now, a professional service corporation can still be an S corporation, and it provides liability protection, but the liability protection is limited because a professional service corporation does not protect you from malpractice or from negligence. For example, if you're a doctor and you're operating under a professional service corporation, you can still be sued for medical error and your personal assets will be at risk. To mitigate this risk, it's essential for professional service corporations to maintain a robust professional liability and a malpractice insurance policy. The fourth major benefit of an S corp is the QBI deduction, also known as the Qualified Business Income Deduction or the Section 199A deduction. Now, this is a significant benefit for S corporations. This is essentially a deduction that was created under the Tax Cuts and Jobs Act of 2017, and it was most recently made permanent with the One Big Beautiful Bill Act of 2025. Now, this allows eligible business owners to deduct up to 20% of your qualified business income from your personal business taxes. So let's take a very basic example. Assume that your S corporation earned $300,000 a year in net profit and you were eligible for the full QBI deduction. You can then deduct $60,000 from your taxable income, which is 20% of $300,000. Now, that's a huge tax savings that's not available for C corporations, which is another reason why the S corporation is a preferred choice for a lot of entrepreneurs. Now, of course, I'm oversimplifying the QBI deduction because, like with anything with the IRS, there are so many eligibility rules and not everyone qualifies for the full deduction. For example, if you're an S corporation and you're qualified as a specified service trade or business and you meet certain income limitations, it's going to preclude you from being able to take the full QBI deduction. So shareholders of non-specified service trade or businesses whose income exceeds an allowable limit, they have to use like a complex formula to be able to come up with the QBI deduction. But nevertheless, it's still a very big deduction for S corporations that C corporations do not benefit from. The fifth benefit of the S corporation is the ability to do the pass-through entity tax. See, the Tax Cuts and Jobs Act of 2017 introduced a significant change for individual taxpayers. It imposed a $10,000 cap on the amount of state and local income taxes that they can deduct on their personal tax return. Now, this cap disproportionately affected business owners and other high-income earners in states like California and New York. But to address this limitation, most states, including California, have created a workaround known as the pass-through entity tax. Now, this workaround allows you, the business owner, to pay a voluntary tax to the state from your corporation. This lowers your corporation's net profit on a federal level, meaning you pay less tax in total. Then you get a credit on your personal tax return for that voluntary tax that your corporation paid. Now, this sounds actually confusing, but it is a benefit for S corporations because the federal tax code limits the individual SALT deduction, the state and local income tax deduction, but it doesn't have a limit on the amount that a business can deduct. By electing to have your corporation pay that state income tax at the entity level, your S corporation can take a full deduction of that business expense on its federal return. When it takes that deduction on the federal return, your taxable income is now lower. When your corporation deducts that state tax, its overall income is reduced. Since the income is then passed through to you on your personal tax return, your personal income tax is now lower, hence resulting in a lower federal tax bill. So in short, the pass-through entity tax is a legal workaround that lets you as the S Corp owner to fully deduct your state and local taxes by providing a significant reduction to your overall federal tax liability. The sixth benefit of the S Corp is its professionalism. One of the more subtle but equally important benefits of the S Corp is the professionalism and the credibility it brings to your business. When you incorporate, you add the words INC, Inc., or the word corp to your company name. Now, this simple change adds a layer of legitimacy that a sole proprietorship just doesn't have. Also, operating as a corporation adds a layer of seriousness and professionalism that can help you in a variety of ways. It can improve your relationship with your customers, making them more confident in your business. It can help you with your vendors, your lenders, potential investors who often view corporations as a more established and reliable entity. The seventh benefit of an S corporation is its perpetual existence. Unlike a sole proprietor or partnership, which legally does not exist if one of the owners or partners dies or leaves, an S Corp has perpetual existence. The corporation is a legal entity that is separate from its owners. That means that the business can continue to operate indefinitely, regardless of the change in ownership or the death of a shareholder. Now, this stability is a powerful benefit for long-term business planning and for assuring customers and vendors that the business will continue long-term. The eighth benefit of an S corporation is that it's easier to transfer ownership of the stock. Now, because an S corporation's ownership is represented by shares of stock, it simplifies a process of transferring the business to a new owner or to a new family member of a succession plan. The company can continue to exist and operate even if the ownership changes. Note that selling your shares to an ineligible shareholder or being an ineligible shareholder yourself will result in the termination of your S Corp status. So be very careful on how you buy your shares in S Corp and who your fellow shareholders are, because you can still lose your S Corp status even if another shareholder makes a mistake. For example, if you're in an S corporation and you're an eligible shareholder, but another shareholder sells their stock to an ineligible shareholder, that means your S Corp status could be revoked by the IRS, even if you didn't do anything wrong. So you got to be very careful on who your fellow shareholders are and what type of transactions they're engaging with the shares of the S Corp. And the ninth benefit of an S Corp is that S corporations historically have a lower audit risk compared to sole proprietorships, partnerships, and C corporations. Now, there is some buzz floating around that's slowly changing, but historically speaking, S Corps do have a lower audit risk than some of the other entity structures I just mentioned. So as you can see, the S Corp is much more than just another business entity. It's a powerful strategic choice that offers a unique combination of financial and legal advantages. From a tax perspective, we've covered the big wins. You eliminate the double taxation, which is a big financial relief. You can significantly lower your payroll tax burden by paying yourself a reasonable salary and then taking the rest as a distribution. You can take advantage of the QBI deduction, and in high income tax states, you can even do the pass-through entity tax. These and all the other benefits I mentioned are what make the S Corporation so appealing. But beyond the tax benefits, the S Corp gives you crucial limited liability protection, shielding you from personal assets of your business debts. It also lends your business a higher level of professionalism and credibility, which can open doors for your customers, or with your customers, your lenders, and your investors. Plus, it provides a stable framework for things like succession planning and even offers a lower audit risk compared to other structures. The bottom line is this: if you're running a profitable small business, the S Corp is a structure you simply cannot afford to ignore.